Choosing your business structure is one of the foundational decisions you'll make as an entrepreneur. It's a decision that resonates throughout your entire business operation, influencing everything from day-to-day management to long-term financial strategy. It is a critical decision for every entrepreneur, demanding careful consideration and a clear understanding of the implications. This isn't just about paperwork, it's about setting the stage for your business's financial health and future growth. It directly impacts how much you pay in taxes each year, potentially saving you a significant amount of money if you choose wisely. Understanding these impacts can be the difference between thriving and just surviving. The IRS treats each structure differently, with varying rules and regulations that can significantly affect your bottom line. Navigating these differences is crucial for compliance and for optimizing your tax strategy, affecting your profits and tax responsibilities in ways you might not immediately realize. It's not just about paying taxes, it's about understanding how your business structure shapes your overall financial picture. For example, a sole proprietorship and an LLC may look similar on the surface, both offering simplicity in setup and operation. But their tax implications can be very different, leading to vastly different outcomes when tax season rolls around. These differences can impact everything from your self-employment tax to your ability to deduct business expenses. The right choice, made with careful consideration and informed by expert advice, can save you thousands of dollars annually and simplify your financial life, making tax preparation less stressful and more efficient. A well-chosen structure can streamline your accounting processes and free up your time to focus on growing your business. Your structure determines which tax forms you file, influencing the complexity of your tax returns and the information you need to gather. Deadlines, ensuring you stay compliant with all IRS regulations and avoid penalties. And the types of taxes you owe, from income tax to self-employment tax, and potentially even state and local taxes. It also affects your personal tax return and long-term planning, influencing your overall financial strategy and retirement savings. Some structures expose you to higher self-employment taxes, which can take a significant bite out of your profits, especially in the early stages of your business, while others offer ways to reduce that burden through deductions, credits, and other tax-saving strategies. Learning these differences now is a smart investment in your business's future, setting you up for long-term financial success and stability. Remember, your structure isn't permanent and you have the flexibility to adapt as your business evolves. You can change it as your business grows and your needs change, ensuring your business structure continues to align with your goals. But starting with the right fit gives you a major advantage, positioning you for success from the outset. This guide will break down the tax details of sole proprietorships, offering a clear understanding of their advantages and disadvantages, and LLCs, providing you with the knowledge you need to make an informed decision, to help you make the best choice for 2025 and beyond, setting your business up for a prosperous future. A sole proprietorship is the simplest way to start a business in the US. If you start a business alone and don't register it as another entity, you're automatically a sole proprietor. There's no legal paperwork required. Your business and personal finances are one and the same. All profits are your personal income, and all debts are your personal responsibility. This is called unlimited liability, meaning your personal assets are at risk if the business can't pay its bills. The simplicity is attractive for freelancers and new entrepreneurs. You can operate under your own name or register a doing business as DBA name for a small fee. There are no complex compliance requirements. Just track your income and expenses for taxes. This makes it easy to test a business idea without major legal or financial commitments. For many, the lack of red tape is the perfect way to get started. An LLC is a formal business structure created under state law. You must file paperwork with your state to form one. The key benefit is in the name-limited liability. Your personal assets are protected if the business is sued or incurs debt. Creditors can only go after the LLC's assets, not yours. Forming an LLC requires a unique business name, articles of organization, and a filing fee. Most states require a registered agent to receive legal documents. An operating agreement is recommended to outline how the LLC is run. LLCs are more flexible and less complex than corporations. No board meetings or corporate minutes required. They can have one owner, single member, or several, multi-member. This makes LLCs a versatile choice for many small businesses. When you operate as a sole proprietorship, understanding how taxes work is crucial. One of the key features is pass-through taxation. This means that your business, profits and losses go directly to your personal tax return. There's no separate business tax return to file. You report all of your business income and deductible expenses on Schedule C, which is where you detail your profit or loss from the business. This completed Schedule C is then filed along with your individual Form 1040. After subtracting all eligible business expenses from your gross income, your net profit is considered your taxable income from the business. This net profit amount is then added to any other income you have, such as wages or investment income, and it's all taxed at your individual personal income tax rate. As a sole proprietor, you're also responsible for paying self-employment tax in addition to income tax. This self-employment tax essentially covers both the Social Security and Medicare taxes. For the year 2025, the combined self-employment tax rate is 15.3% on the first $177,700 of your net earnings. On top of that, there's an additional 2.9% Medicare tax that applies to earnings above that threshold. The good news is that you can deduct 1/2 of your self-employment tax. This deduction helps to lower your adjusted gross income, which can potentially reduce your overall tax liability. Unlike employment, where taxes are automatically withheld from your paycheck, taxes aren't withheld automatically when you're self-employed. Because of this, you are generally required to make estimated tax payments on a quarterly basis to the IRS. Failing to make these timely payments can unfortunately lead to penalties and interest charges from the IRS. Therefore, careful financial budgeting and planning are absolutely essential to ensure you have sufficient funds available to cover all of your tax obligations throughout the year. While the filing process itself is relatively simple, the self-employment tax can indeed represent a significant financial burden for many sole proprietors. Proactive tax planning throughout the year can really help you avoid any unwelcome surprises when it comes time to file your taxes. For many sole proprietors, the relative ease and simplicity of filing taxes is one of the most appealing aspects of this business structure. LLCs offer real tax flexibility, making them a popular choice for small business owners. This flexibility stems from the various ways the IRS allows LLCs to be taxed. Understanding these options is crucial for optimizing your tax strategy and minimizing your tax burden. By default, a single-member LLC is taxed like a sole proprietorship. This is the simplest tax structure for an LLC. All income and expenses from the business are reported directly on your personal tax return, typically using Schedule C. This means the business's financial activity is treated as an extension of your personal finances for tax purposes. As a sole proprietor, you're also responsible for paying self-employment tax, which covers Social Security and Medicare taxes. This is in addition to your regular income tax. Multi-member LLCs, on the other hand, are taxed as partnerships by default. This means the LLC itself doesn't pay income tax. Instead, the LLC files Form 1065 to report its income, deductions and credits, and then issues Schedule K-1S to each member, detailing their share of the LLC's profits or losses. Each member then reports their share of profits or losses, as indicated on their Schedule K-1. This information is included on their personal tax return, and they pay income tax on their share of the profits. Here's the advantage. The real game changer for LLCs. LLCs have the option to elect to be taxed as either an S corporation or a C corporation, providing significant tax planning opportunities. With an S corp election, which is a popular choice for many LLCs, you can pay yourself a reasonable salary for the work you do in the business. The IRS requires that this salary be commensurate with your skills and the services you provide. Then you can take the remaining profits as distributions. This is where the tax savings come into play. Only the salary portion is subject to payroll taxes, including Social Security and Medicare. The distributions you take are not subject to self-employment tax, which can result in significant tax savings. For example, let's say your LLC generates $100,000 in profit. You might decide to pay yourself a salary of $60,000, considering your role and responsibilities within the company. This $60,000 is subject to standard payroll taxes, including Social Security and Medicare. You then take the remaining $40,000 as a distribution. This $40,000 distribution is not subject to self-employment tax, leading to considerable savings. This strategy can potentially save you thousands of dollars each year in self-employment taxes. Electing C Corp status is less common for small businesses due to its complexities. The primary reason for this is the potential for double taxation, where profits are taxed at the corporate level and again when distributed to owners. However, it can be a beneficial option for some businesses, particularly those seeking significant capital investment or specific tax advantages. The ability to choose your tax treatment, whether it's as a sole proprietorship, partnership, S-corp, or C-corp, is a major benefit and a key reason why many entrepreneurs choose the LLC structure. Keep in mind that the S-corp election does add complexity to your tax filings. You'll need to manage payroll, file additional tax forms, and ensure compliance with all relevant regulations. However, for many businesses, the potential tax savings can be substantial and well worth the added effort. The right choice ultimately depends on your specific profit level, business goals, and long-term financial strategy. It's always a good idea to consult with a qualified tax professional before making any tax elections for your LLC. They can help you assess your situation and determine the best course of action. Let's compare the tax pros and cons of sole proprietorships and LLCs. Sole proprietorships are simple. Just file Schedule C with your personal return. This keeps costs and paperwork low, ideal for new or low-profit businesses. The downside? Every dollar of profit is hit with self-employment tax, with no way to split income for tax savings. LLCs, on the other hand, offer flexibility. With an S-corp election, you can split income into salary and distributions, reducing self-employment tax. This makes LLCs more scalable as profits grow. The trade-off is more complexity, state fees, payroll, and higher accounting costs. You'll need to weigh these costs against the potential tax savings. For many, the flexibility and protection of an LLC outweigh the extra effort. The best choice depends on your business's size, profit, and growth plans. For 2025, keep an eye on tax law changes that could impact your business. The Qualified Business Income QBI deduction, worth up to 20% off your business income, is set to expire after 2025 unless extended by Congress. This deduction can mean thousands in savings, so plan accordingly. IRS inflation adjustments will change tax brackets, standard deductions, and retirement plan limits. Higher contribution limits mean more tax-deferred savings opportunities. Worker classification rules are under scrutiny. Misclassifying employees as contractors can lead to big penalties. Stay compliant and consult a tax pro to avoid costly mistakes. Proactive planning is key as the tax landscape evolves. The right structure depends on your income, risk, and business type. For freelancers earning under $50,000, a sole proprietorship is usually simplest and most cost-effective. Once profits exceed $50,000, $60,000, an LLC with S-corp election can deliver major tax savings. If your business carries liability risk, like construction or retail, LLC protection is invaluable. Low-risk businesses like writers or consultants may stick with a sole proprietorship until profits grow. Always project your income and run the numbers before switching structures. The break-even point for an LLC often comes when tax savings outweigh extra costs. Consult a tax professional to tailor your decision to your unique situation. Which structure saves you more? It depends on your profits. For low-profit businesses, sole proprietorships are tax-efficient and easy to manage. As profits grow, LLCs, especially with S-corp election, offer big tax savings by reducing self-employment tax. LLCs also provide crucial liability protection for your personal assets. While LLCs cost more to set up and maintain, the tax and legal benefits often outweigh the expense for growing businesses. The choice is a trade-off: simplicity versus opportunity. For most, an LLC with S-corp election is the best way to keep more of your money once profits are steady. Plan ahead and choose the structure that fits your business now and in the future.